Are you worried about interest rates continuing to rise and then buying points in order to buy the rate down? Or maybe you're just not buying real estate at all. I'm Kathy Fettke, and welcome to On the Markets YouTube channel presented by Fundrise. Today I'm going to talk about rates. And the reason I am on a tennis court is I'm going to use the tennis ball as an example of rates. So if you play tennis, you know the joys of brand new tennis balls. They just, you get that popping sound and you get a beautiful, fresh tennis ball. And when you hit it, it bounces so nicely. Okay, I'm not very good at tennis, but a new tennis ball is a great thing because it's light and bouncy. Okay, now we have an old ball and I'm going to dip it in this bucket and I'm going to get it soaking in water. All right, so here's our soggy tennis ball and I'm going to try to hit it now. So what does this soggy ball have to do with interest rates? Well, we know that the Federal Reserve is raising rates, the overnight lending rates, to slow down the booming economy and hopefully curb inflation. And we've had rapid rate hikes this year from 0% overnight lending rates to now 2.5%. And it's really shocked the market. But what's really shocking is that back in the 80s, the Fed would lower rates to 9% to slow things down. And in the 90s, they would lower rates to 3%. That was considered enough to stimulate the economy. But fast forward to today, 3% is considered really high and will slow down the booming economy. Of course, we're coming from 0. So what does this mean? Why the change? Well, the biggest change with the national government is the national debt. We're over $30 trillion in national debt. So if the Federal Reserve were to raise rates too high, the US would default on its debt. We simply wouldn't even be able to pay the interest on it. So that's why interest rates are a soggy ball. They're weighed down by all of this debt. Now, that was the overnight lending rate, the rate that they're always talking about when the Fed is talking about raising rates. But mortgage rates aren't necessarily tied to the Fed fund rate. Mortgage rates are more tied to the 10-year US Treasury. And that's another interesting thing to look at. When investors are looking for security, they buy bonds. They find that to be secure. And when a lot of investors are buying bonds, well, then the bond yield goes down because it doesn't have to go up to attract investors. So generally, when investors are a little bit scared of what's going to happen in the market, they buy bonds, and that lowers the bond yield. It also lowers mortgage-backed securities because they're in the same camp, and investors will buy that as well when they're feeling scared about things. Now, when there was the thought that inflation would last forever, then investors were getting out of bonds and getting into other things that would go up with inflation. Stocks like oil, gas, food, housing, because those inflate, and investors can make more money in inflationary items than with the bond market. Now, what we've seen is that actually investors are flocking to bonds again. So the US Treasury note, the 10-year Treasury, kind of hit a peak in June of about 3.17%, and it's been on its way down since. And this tells you a lot, that investors are thinking maybe inflation has hit a peak and is coming down now, and they're going to be safer in bonds. If mortgage rates follow bonds, that's maybe why we've been seeing mortgage rates go down. So if you're in the camp that mortgage rates are going to go to 8, 9, 10%, then you would have to believe that the US economy is going to be robust and just investors from all over the world are going to want to come and invest here. That's not what we're seeing. We're seeing an economy that's way down, right? With all this debt. It looks like we're going to be seeing an onward trend of mortgage rates going down. So I personally am not too worried about rates going up. I think they have already done that. A lot of the markets already priced it in when they knew that the Fed was going to raise rates, and they appear to be going down. So if you're concerned, you can certainly buy points to lower your rate. But you got to remember, it's going to take years to pay those points off. I just talked to somebody today who paid 3 points to lower their rate, and they said it's going to take 5 years just to pay for those points in the cash flow from the property. I think a better solution would be jump into real estate today when there's fear in the air and prices are, there's room to negotiate. And then you can always refi later, and that would probably be cheaper than paying points. Just my personal opinion. Again, I believe that there's so much fear in the air from all the headlines that this could be maybe one of the best opportunities to invest in real estate today. You might be paying a little bit more for your mortgage, but really not that much. They're in the 5s right now. That's pretty good historically. When I started, they were, coming down to 7, and that was a really great deal. So this is a great opportunity, in my opinion, to get a deal and refi later. I'm Kathy Fettke. Thanks so much for joining me on the Markets YouTube channel, brought to you by Fundrise. And if you have any comments on what you think about that, if you're worried about rates going up or down, or if it's time to buy or not, put it in the comments and I'll be sure to respond. This is an economy that is producing lots of things and not loaded down with debt. Look at that. This is an economy who's not producing a lot of things and is loaded with debt.